All right, what's up, everybody, and welcome to another episode of the Abundance Podcast. So, here with us today, we have Brian Head. Brian is a seasoned real estate investor who is currently launching his own investment fund. So, Brian and I today are going to discuss the macroeconomic trends. We're going to discuss money raising, real estate investing, and building and managing your own investment fund. So, what's up, Brian? How are you, man?
Good. How are you doing?
Pretty good, thanks. Thanks for coming in. And so, why don't you start by introducing yourself and telling people a little bit about your story and your background?
Sure. Yeah, happy to. So, yeah, my name is Brian Head. So, I'm born and raised here in San Antonio, Texas. I've been here all my life and married two kiddos, a 5-year-old and 12-year-old daughters, and they keep us pretty busy. Um, and had a couple of different jobs, but my most recent one, actually, I had a job for working for a larger financial services firm here in San Antonio. Left actually in May of last year after almost 25 years, and left to pursue the real estate, multifamily real estate investing full time. Been investing in real estate for over 20 years. Started out in single family flipping and rentals, did some small multifamily, triplex, duplex, Airbnb, things like that. But a few years ago is when I started getting into the larger multifamily deals, 100 plus unit apartment complexes, all here in Texas. And so that's kind of what I've been focusing on. And that's what you mentioned. I have a fund that just launched. That's what my fund is focusing on as well.
Awesome. And is your fund launched or is it in the process of getting started?
Yeah, no, it's officially launched as of a few weeks ago. So we've got our first deal, a 360 unit apartment complex in Dallas that we invested in. We've got another one that we'll be closing on in San Antonio as well, in San Antonio, Texas. And so the fund is all going to be multifamily properties and all in Texas. So it's going to be just focused on that segment. Texas is a really great market to invest in from a real estate standpoint.
Mhm.
I don't know if you knew, but if Texas was a country from a GDP standpoint, it would be the ninth largest in the world.
I
Um,
didn't know that.
yeah, bigger than Russia, bigger than Spain.
The GDP?
GDP from a GDP 2.4 trillion. I think we'll be number 8 probably this time next year. So yeah, pretty big economy here in Texas. Pretty diversified, a lot of different things. Obviously, there's a lot of oil here as well. But yeah, it's a huge state. A lot of people moving here, over 1,000 a day moving to Texas. So we don't have a problem from a migration standpoint. But just like most of the country, we have a problem with the supply from a supply standpoint with housing. And so that's good for multifamily investors because when you combine that with the fact that single family houses have gone up so much in value and real estate, sorry, not real estate, interest rates going up so high so quickly, it's made it difficult for a lot of folks to be able to afford to buy a house, unfortunately. But that does create opportunities from a multifamily standpoint because you're going to have more renters, right? And so that's one of the things that we're taking advantage of here in the Texas market in the multifamily space.
Yeah, that's the advantage of a multifamily. That's the competitive advantage. And I'm not into real estate, but if I were to go into real estate, I would probably go there, especially in this kind of environment where there's a high probability of a recession. So multifamily, even in the recession, people still need apartments.
Yep.
And I don't know, like, what's the average rent of your apartment complex?
Yeah, I mean it varies by location, but and obviously by number of bedrooms and things like that, but 11, 12, 1,300 a month, something
Mhm.
like that, somewhere around that range. It just depends on the unit, but that's pretty typical for the San Antonio market. Some of the other markets like Dallas, it's a little bit more. Austin's more, but San Antonio is a little bit more. I would consider a little bit more of a stable market. So yeah, that's kind of what we're looking at over in the San Antonio market.
Mm-hmm. Yeah. And so in your fund though, how like what's the plan? Are you just buying buildings or are you buying syndications? Like what are your what's your thesis? What's your secret sauce?
Yeah, so the fund is going to be investing as a limited partner in other syndication deals. And so there's a couple reasons for that, but one of the main reasons is I don't want to be tied to investing in a deal in my fund that I have to be a general partner on. I want to be able to invest in anybody's deals. So by having the fund set up to where it can invest in syndications directly, it allows me to kind of cherry pick the deals I want to invest in without, any kind of a conflict of interest, or, it's got to be a deal that I'm a partner on or anything like that. It allows me to really truly be a fund manager and look for the best deals out there and focus on that for the investors. And so that's kind of why I've set it up that way. Plus, the fund is going to be a diversified fund. So, anybody that invests in the fund will be investing in 5 to 10 properties. So my goal is to purchase 5 to 10 properties within the fund. And so that way, when you're investing, let's say $50,000, $100,000 into the fund, you're diversified across a portfolio of properties and different sponsors and general partnership teams, so that you're not putting all of your eggs in one basket, putting your $50,000 or $100,000 all into one apartment complex, which could go south, or that particular partnership team, maybe there's an issue or something. This allows you to be diversified across multiple different apartment complexes and spreads out your risk. And so that and diversification has always been kind of important to me, going back to when I was a stockbroker and financial advisor for 10 years, back for the company I used to work for. Diversification was always a big component of what we did. And so I kind of have carried that into the real estate space.
And that makes sense because your fund, you're not only diversifying over different projects, but you're also diversifying over different teams because you're not the one actually doing the. Well, I mean, you're not the general partnerships of the general partner of each different deal. You're
Correct.
kind of a fund of funds, but you're a fund of syndications. But it's pretty passive for you, so your investors don't get only a diversification over various sectors and various projects, but also over various management teams, right?
Right. It provides a lot of different levels of diversification, right? So like you said, management team, apartment complexes, geographical diversification, because I'm not just going to be, it is going to only be in Texas. But I've got, like I said, a deal in Dallas. There's going to be one in San Antonio. I'm looking at Houston, Austin, right? Some of these larger metropolitan areas in Texas. And so it's going to give you that diversification, because the reality of it is, and there's still, I'm not saying there's not good deals out there to invest in a particular apartment complex or syndication, but the different syndicators and different general partners, they do have different ways of underwriting sometimes. Some of the basic concepts are the same, but one may be a little bit more aggressive with their rent increases that they're projecting out than another, right? And so really overall, I'm looking for conservative underwriting on these deals. But this, like you said, it is important, I think, to be spread out across different partnership teams as well, because they do have different ways of underwriting the deals. They also have different ways of managing the property. And these first 2 deals I'm invested in, these partnership teams are what's called vertically integrated. So they own the property management company as well that's going to be managing the property. And so that, you've got different property management companies that you're diversifying into as well. So it just provides a lot of diversification. And I think during the economy and all these uncertain times like what we're dealing with right now, I think that's more important than ever.
So why don't you talk a little bit about your view on the macroeconomic situation and how it will affect real estate, multifamily, and what is your projection for the interest rates?
Projection for interest rates. Well, I know we're going to find something out. I don't know when. I'm sure by the time this posts, that tomorrow will be history. But yeah, so we should know something more. I think the consensus right now is 25 basis points for the next interest rate increase. It's all over the place in terms of, okay, what happens from there. I think what I'm hearing mostly is that they'll probably pause for a little bit at that point. And then, it's all over the place in terms of, well, when do they start potentially lowering interest rates again? That's just going to be so dependent on what happens with the economy. But, there's anywhere from people saying toward the end of this year, they'll start lowering interest rates again, or into next year at some point. I would personally lean more toward next year, just based on where things are and what I'm seeing. But it really is going to depend on what happens in the economy, and do more banks fail? I mean, we just had another one yesterday, so that's, as these banks fail too, that's helping the Fed do. That's doing some of the work for the Fed as well. That they've even mentioned that these banks failing and lending practices getting tightened and stuff like that is also contributing to. It's almost like they're raising rates more with some of those types of things that are happening. So the economy tightening and things like that, and so it's going to be interesting. It's an interesting time. We haven't really had anything. You obviously have. There's a lot of talking heads out there comparing different other times to this and what the Fed's done and things like that. But it's so different from the perspective of coming out of a pandemic and how the pandemic has changed so much that we still don't understand. And so I think there's a lot of uncertainties. And going back to your point earlier, that's why I like multifamily, because regardless of what happens, people are going to need a place to live. And so that doesn't change. Sure, rents could go down. There could be some negative impacts there, but people are still going to need a place to live. We still have the supply demand from a housing standpoint that there's still not enough supply to meet the demand. Again, with Texas, you've got over 1,000 people moving here every day. Being a very business-friendly state, you've got a lot of businesses moving here, right, which is also contributing to the employment. And so, I think there's just a lot of uncertainties right now, and that's why. What I found too, though, is there's this uncertainty has created a lot of fear for investors as well, right? And you can appreciate some of that, and I know with what you're doing with some of the trading and options and so forth, and fear and uncertainty and volatility can be good in what you're doing, right? But I think that it can be good in real estate too, because there was a lot of these syndication deals, a lot of these apartment complexes purchased on variable rate loans, and that is presenting opportunities. That Dallas deal that just closed, as an example, right? That was a distressed seller. That was somebody that they had to sell because their rate cap, which is basically an insurance policy that caps the rate that you'll have to pay on that variable rate loan. Is basically you pay that higher interest, but then it's an insurance policy that reimburses you for that higher interest payment you had to make. Anyway, that owner of that property, that rate cap was getting ready to expire. And so they were in a situation where they were going to see a huge jump in their interest rate payments and be put in a negative cash flow situation. So they were desperate to get out of this property. And that presented an opportunity for the group that purchased that, and which then, of course, presents an opportunity for my fund to go in and invest in that deal. There's going to be more and more of those deals coming up because of all the variable rate loans that were purchased and the prices of these apartment complexes were purchased over the last few years. So it's going to provide some opportunities. The challenge is there is a lot of fear, and people are afraid to invest right now. But right, you don't want to buy high and sell low. You want to do the inverse, right? And I think that's where sometimes people's emotions get the better of them. And one of the reasons why I like real estate is it takes the emotion out of investing, because you can't just log onto your account with Fidelity or Schwab, right, click a button and sell your stock when you hear some bad news about a bank failing, right? You can't do that on an apartment complex, right? So, and I've even heard Warren Buffett, talk about, the whole idea of these real-time quotes and everything. That's great, but now not only do you have that, but now you have all the anxiety and the emotions involved in people reacting to those quotes and everything, and then selling, the stock when maybe they shouldn't. And he actually has a quote that I saw just the other day. This is from a while back, but where he's like, he literally said, if you own a farm or you own an apartment building, we don't go look and see what the price is every day and decide what we're going to do from there, right? He said, using the farm as an analogy, he's like, you just look at the number of bushels that it's producing, right? And what the income is that it's producing. And that's what we're focused on. We're not focused on the day-to-day volatility and fluctuations. And so that's perfect for what you're doing, right? But for real estate, it's a different dynamic, and it takes some of that away. And so I do find intriguing what you do, because that's the emotions are a component you're what you're doing, you're removing the emotion as well and looking at different trends and things like that, I'm sure. But most people invested in the market aren't doing that, right?
Yeah, I
Um,
mean, so a couple of different things I want to say. So first, yeah, of course, emotions are what drive the market. I mean, it follows the macroeconomic growth, but then there's the debt cycles, and then which is basically caused by emotions and by greed and fear. And so the goal, a goal as an investor is first to find your competitive advantage, your hedge.
mhm.
I mean, the second step, which is as much as important, is to remove the emotions. So for that, you either become really good at removing your emotions, or you code it into an algorithm. So I've done both. I've done both. Right now on my phone, it's not into an algorithm yet because it's also really easier to control my emotions with what I'm doing with my fund, because we're not trying to predict the market, right? Whether the market goes up, down, sideways, it affects our trade, and we adjust and we have different rules for the different situations, and we're ready for every potential opportunity, and it does affect the P&L, but we don't really care because we make money no matter what, and we just react appropriately to the different thing that happens. So
Mhm.
what I'm trying to say is that it's way easier to control your emotion when you're not a directional trader, because what we really take advantage of in our fund, like is time passing by. Like really, because
Right.
with option, when you buy a contract, each day the contract loses value
That time value. Yeah. Mhm.
because it has an expiration, right? So what we're doing is that we have different we buy and we sell options at different prices, and we have different structures, but at the end of the day what we do is that we're net short, so meaning that we sell contracts at the end of the day. And so it's basically like an insurance company, right? We're kind of taking the risk of a crash in exchange for getting a cash flow of a cash flow coming in the fund. And there's a lot of people who also compare what I'm doing to real estate, because I'm kind of renting my shares of the underlying that I'm trading.
Mhm.
So and also what you said about being uncorrelated to the market, it's amazing right now because re- being in multifamily, it's kind of recession proof, and being like a alternative investment which has a asymmetrical return in comparison to the underlying market condition, that's
Mhm.
also very variable right now.
Right. Yeah. Yeah, and it's yeah, I find what you're doing fascinating as well, because I remember back in my day trading options and thinking I was doing great, and I have no problem admitting right now that I think my net of my option trades are definitely a loss. So I realized quickly that I thought I knew more than I did when it came to that. So, but
Hmm.
yeah, that's very interesting. But yeah, yeah, real estate is just I think that real estate should be a part of everybody's portfolio. What that allocation should be is really dependent on that individual, where they are in their stage of life, different things. Real estate generally is very illiquid unless it's a REIT or something like that, which personally I don't. My personal opinion is you're not truly investing as much in real estate if you're investing in a REIT as you are in these private placement deals. But um, I think it should be a portion of everybody's portfolio. Uh,
Hmm.
and I was actually doing the mental math in my head the other day, and came to the realization that I've made about a quarter of my net worth in the stock market and three-quarters of my net worth in real estate. And
Yeah.
so, everybody, the thing about it is and I'm not one of those real estate guys that's going to come up here and say, well, real estate's the only thing you should do, and that's it, and don't do options, and don't invest in this fund or whatever, don't invest in stocks. To the contrary, I think you should be diversified in your holdings as well. You should have diversified streams of income and different things like that. And so I think that's really important. And this is where it's times like this when people will really come back and go, dang, I wish I was diversified, right? When some things are going down, and so yeah, it's I think that for as long as we've been around, right, real estate has been a great way to build generational wealth, and I don't
Hmm.
see that changing anytime soon.
And so would you say that multifamily is the best performing type of real estate in a recession?
I don't know if well, to me, it's one of the safest. Just going back to people needing a place to live. There's you definitely, especially right now, office space is a challenge right now.
Yeah.
And it does depend a little bit on the office space. Like the big office buildings is really bad, right? Some of the smaller ones that are like doctors' offices and things like that, those are still around, and that's probably not going to change a whole lot. But uh, you know, um, I haven't personally invested in a lot of the other spaces like self storage. Some of those other, I am. So one other type of commercial asset that I do believe in that I have invested in is it's called industrial service facilities, industrial type commercial property. There's basically this type of commercial property is basically you buy a chunk of land, you clear it out, you put in some road base fencing, lighting, security gate, electricity, plumbing type thing, and you find somebody that needs to rent that space on triple net lease. Maybe they need to store heavy machinery, equipment storage, or something like that on the property, and you rent that to them. And this is another way, and I think it's actually a good diversification play outside of multifamily, but still in real estate, because with multifamily, it's very labor intensive from a management standpoint, right? Because you're managing all of these hundreds of tenants, and what I primarily focus on and what my fund is going to focus on is value add multifamily, right? So basically properties that need to be rehabbed, right? And so that, if you've got a couple hundred units of properties or a couple hundred units, right, you've got to rehab those. That's going to take a few years. You're not going to do that in a year, right, or 6 months. So the capital that you have to put into it takes time. These other types of projects, these industrial facility type projects, they are you're talking a few months in terms of your capital improvements that you have to do, and the management of the property is really low because you've got one, maybe two tenants on a triple net lease. And so I think it's a good diversification play with multifamily. So I've invested in a few of those deals in the Houston market, and I wanted to invest in those last year to kind of see how it went and kind of test the theory and everything, and they've gone really well. And so I'm actually going to be partnering probably with somebody this year on some of those types of assets as well in the Houston market, kind of on the way to the ports in Houston and things like that. And so that's definitely something I'm exploring as well. So looking at other ways besides multifamily, but for me, multifamily will probably always be a core holding for me personally.
Mhm.
I just am a really firm believer in it, and that just goes back to being, investing in real estate over 20 years and in the residential type real estate sector. I've been through some cycles. I had some properties before 2008. I bought a bunch more after 2008. So I've been through some of these different downturns and things like that. And did some of those properties go down after 2008? They sure did, but they came right back and did really well. And I've always been a big believer in finding value, buying a property for a discount going in. I was never one of those ones where I was speculating on appreciation. There was a lot of people doing that back in 2006, 7, 8, right? And those are the people that got in a lot of trouble, just buying something, just waiting for expecting it to appreciate. I was buying things that needed work, so I was getting them at a discount already. And so, to me, I'm always looking for that deal and that discount, and so that's what I focus on.
That makes sense. So you talked about 2008, and I know there's a lot of people, and personally I'm kind of bearish on the whole economy, but there's a lot of people that are making some comparison between the current economic situation and 2008. There's various economic indicators like consumer debt, personal credit card debt,
Yeah.
that are really similar to 2008. So do you think we might be looking into some kind of other crisis? Of course, it won't be this time. It won't be that much focus on into real estate. It'll be
Mhm.
like more into the global economy and the value of the dollar. But what do you think? Is there a big threat?
Yeah, so like you said, I think it'll be less impactful on real estate because back then there wasn't the supply and demand dynamic in real estate that there is now.
And it was actually fraud back then.
Yeah, and but that whole situation back in 2008, like just slow down all housing development and everything. And then with that dynamic, right, we haven't recovered from that from a supply demand standpoint. And then you add in COVID, then you add in the appreciation of single family houses and the increase in interest rates, and which is slowing down some building too. Like all those dynamics from a real estate standpoint, I just supply and demand typically wins that concept. So I don't foresee that being a problem. I am a little bit concerned though. There could be some bleed over into real estate a little bit because if, like you mentioned, the debt, right? That's definitely a problem. And I do have concerns about the dollar as well, and some concerns about the overall economy going forward, longer term even. But
Mm-hmm.
I think that for what I'm focused on in the real estate space, I'm not as worried about it because again, it's a physical asset and people need a place to live.
Yeah,
But
that
but
makes
I,
sense.
I share some of your same
Hmm.
concerns though longer term.
Yeah, especially long term, because in the past everybody was saying, yeah, there might be risk short term, but long term, over 10 years or 20 or 50 years, you're obviously gonna make money in the stock market. But right now, it's like, yeah, you can make money in 5 years or 10 years, but if you hold 50 years, then that might not be good because of everything going on with the petrodollar and the dollar as a world reserve currency and everything.
And
But
I
yeah,
see some of that, and I see some of that potentially changing, and that's some of the concern that I have is, these some of these other countries are already talking and
China.
negotiating, yeah, about well, let's the whole U.S. dollar being the currency. Let's
The
let's
world reserve
talk about,
currency, yeah.
exactly, yeah. Let's talk about that. Maybe that shouldn't be the case, right? And so those conversations are happening, and that definitely concerns me from a longer term standpoint. I
Mhm.
think there's definitely going to be some problems there. I think there's things there that people aren't thinking about right now, for sure.
And what would happen to you if you were in like $1 million debt? Eventually, you'll have to pay it, whether you're an individual, whether you're a company,
Mhm.
or whether you're a country. So if the as long as the US will be able to print the world reserve currency as much as they want and to keep the demand for the dollar high by forcing everybody to use the dollar in every exchange of goods between countries, we're gonna be all right, right? We're gonna be have. I think the national debt overall is like $93 trillion, something like that. I think, I'm not sure. Um, so, but as soon as the demand for the dollar decreases, people, the other countries are forced right now, like by law because of the petrodollar agreement, to buy treasury bonds. So that, of course, that can keep our interest. I'm saying or, but I mean Canada, but that can keep the U.S. interest rate low because everybody wants to buy their treasuries. But
Right.
if that change, the interest rate will skyrocket, and the interest rates are already high, and inflation is already high. So
Yeah.
there's a lot of factors coming in, and like really long term global factors, which I don't really focus on, but I
Right.
follow them.
Yeah, no, I do a little bit as well, and like you said, as long as it's still the world currency, right, it's going to be fine. But if that
Yeah.
changes, so I have, not to be all doom and gloom, but I have a buddy that I really respect that just knows way more than me about everything in the economy. And I asked him not that long ago. I said, so what are your thoughts on the future and things like that? And he just gave me two words. He was like, game over. I was like, what? I was like, oh man, okay, so let's talk some more about that. And so that's when we started talking about the
Mm. Well,
currency.
it's not the first time that this exact pattern has occurred in history.
No, and that's he cited some of those other historical
Mhm. Like
situations.
it's
Yeah,
all cycles, and thanks to Ray Dalio, because I didn't. I'm not saying, and I'm not claiming that I came up and that I noticed these cycles by myself, right? I
yeah,
I read and I studied Ray Dalio's work, but he explains it very well. It's like it's all cycles, and it's not the first time that gold has been removed, has been that the de-dollarization has happened, and that the dollar has been unlinked from gold. It's happened so many times. It happens with the British pound. It happens with the Dutch dollar, and all of these currencies, and it's always the same. An empire rise, they get their world reserve currency, they get into too much debt, their education start lowering, and then what happened is that they share the technology that they create with the rest of the world, but the rest of the world has cheaper labor because everybody in the country in the world order is entitled because they all have the riches because of the fact that they have the world reserve currency. So the labor is high. So these countries make innovation and share it with the rest of the world, but in the rest of the world, the labor is way cheaper. So then that gives other countries the opportunity to fight back and to take back the world reserve. I mean the world order and to
Yeah.
rise. And that is like exactly what happened with China, and that is exactly what happened with the Dutch Empire, and exactly what happened with Britons. So, and this is just one little aspect of the whole pattern,
Yeah.
and everything is just following the pattern perfectly. Like you can see the comparison between the US.
I think we're actually a little bit. We've
100%.
actually been able to go a little bit longer, which is even more concerning, right? Having that fiat currency, and I'm definitely a little concerned about it, and how it all plays out. And I know when you look at the debt to GDP, I mean that's what it's over 100. It's over 100% now. So it's like these are not good. These are not good numbers. These are not good signs. And so and then there's things that could be done to fix the problem. But then when I look at our politics today and how messed up they are, and how people just use and I'm not trying to play one side or the other. I find fault in both sides. It's just there's way too much politics involved, and on one hand, it's like you've got yes, we've got to pay our debts. We can't default. We need to increase the debt limit, right? That's got to happen. But at the same time, you've got the other one, like, okay, but we want to make these changes, so we're gonna negotiate with you. We're gonna tie these changes that we want to get in before we say we'll approve this. And it's like, okay, so you're holding the economy hostage here for this. But at the same time, yes, it needs to be increased. But God, at some point, you got to start having real conversations about
Yeah.
where are you going to cut. It's just like a personal budget, right? You got to figure, like, if you're in a personal budget, it was like if your budget and you were in the situation that this country, the United States is in, you'd be probably filing bankruptcy, right?
Exactly. That's kind of hard to understand, right? Because everybody like has at least heard it, right? The United States is in tremendous debt and like insane debt, but it's kind of vague, right? A country is in debt. Like, what does it really mean? They print the money, and I thought like that earlier, before I really started to study it. But then the more I understood and the more I listened to Ray Dalio's work and other economics work, what I economist work, sorry, what I noticed is that it's it's not that it's complicated, but at the end of the day, it's debt. If you're an individual and you're always year after year, month after month, day after day, spend more than you earn $50, you spent $100, and you constantly, without any exception, every day you spend more than you earn. Eventually, you have to earn more than you spend because you have debt to pay.
Yep.
And it's what's happening with the US. And I don't even know how that will play out, honestly. Um, like, because they're not gonna start earning more than they spend. That is like they've reached a point of no return. I think there's no way where the US government will say, yeah, we'll start reducing or cost, not our cost, but expense. Not on that path at all. So I think they'll just have to default, or they'll just lose the world reserve currency eventually.
Yeah. Yeah. Let's hope they figure something out and they don't default. But yeah,
I mean, it's a matter of time before they lose the
it,
currency.
it definitely appears that way. Yeah, it definitely appears that way. And obviously that would impact everything, real estate, everything.
Raging inflation.
Yeah, I mean, but real estate would still be still need a place to live, right? Like, but
multifamily especially.
right, yeah. So that's why I feel like it's one of the safer bets, given all that we've talked about. Like, it's definitely one of your safer bets when it comes to real estate. And so yeah, but yeah, those are some heavy stuff to talk about, but there's not enough people talking about it, quite frankly.
Exactly. I mean, there's were like a few appearances on the news of the subject, but I find that a lot of people are just they don't think it's a big deal. First, because it's like, all right, you're betting that the whole economy of the US will collapse. Like, okay, but that's first. Second is because there's kind of it seems impossible that the economy of the US will collapse. But and that we'll lose the world reserve currency. But what really is impossible is that it doesn't collapse. The only way that the US like don't lose the world reserve currency, I mean, yeah, that they don't lose the world reserve currency is if they break the pattern that's been happening through all history. Like there's always been a changing a changing world reserve currency. It has never been the same, and the approximate longevity of the last five world reserve currency is between 80 to 120 years, and the US is now at its 79th year. So I think it was the Dutch. I'm going from memory here, but I think they only had the world reserve currency for 80 years. And now, if the US, the way that things are playing out with China and everything,
Yeah.
they're entering like old age. So it would make sense. And if they don't lose the world reserve currency, they would break the pattern of all of history and break every pattern. But for right now, what we're seeing is that they're following precisely the pattern. So it's
Yeah.
like,
I think we've sufficiently scared everybody. Now they're going to be putting all their cash under their mattress or in a coffee can in the backyard, burying it or something.
yeah,
But yeah, that's why my buddy was like, game over. So yeah, hopefully we're wrong. I mean, hopefully there's
I mean,
I
it's a
don't
matter
know.
of timing
Yeah, yeah,
because they will lose the world reserve currency, but it's just when.
right. Yeah, no, I that's a very real possibility. Yeah.
Mhm.
Yeah.
Maybe it's gonna be Canada taking it.
I could think of a lot worse places than Canada to be doing that.
Yeah,
So, yeah,
clearly.
yeah.
There's a lot of hype about kind of unorthodox asset class in real estate, such as like old people homes, funeral homes, and like also RV parks are also a big thing right now, with a lot of people saying that the returns are like incredible. So, what are your thoughts on these types of property?
Yeah, so like the funeral homes, I've never really looked into that, so I don't know too much about that. The RV parks, I've actually looked at purchasing those in the past, and I think those can be good, solid investments. I do wonder, and this is just me not being an expert in that space. I do wonder how much COVID really helped that industry, because there were so many people buying RVs and renting RVs to go traveling across the country because they couldn't be inside, they couldn't do other things. And so I do wonder, how much of that will start decreasing over time, or are those trends kind of baked in now, and that's going to be just kind of how things continue. Kind of similar to, not a very good analogy, but like I look at remote work and people working remote, right? And that's definitely starting to shift a little bit more to people coming back to the office more, and things like that. And I think that's going to continue to increase. And I don't know that we'll ever get back to where we were before. But yeah, RV space, self storage. I think I do like mobile home parks as well. I think there's a lot of value there, not necessarily to own the mobile homes themselves, but the pads and rent out that lot, right? Because when the economy does go south, mobile home parks offer a more affordable type of housing than owning your own home, and even some of the higher end apartments and things like that. And so I think that can be a recession resistant type of investment as well. I used to have a really small one, 4 little mobile homes on the lot, and that was my best cash flowing property of everything that I had. just super high maintenance. But that was probably because I bought something that I wasn't prepared to purchase and manage and stuff like that. But I know that they can be really good investments too. And my first fund is going to all be Texas multifamily, but I am planning to do multiple funds, and so I'll be investing in. I'll be creating some other funds as well. And at that point, as I've learned more about some of these other segments that you've mentioned, I do want to include those in my fund as well. But for my first fund, I'm really being hyper focused on just investing in what I really, really know myself. And so the diversification the fund gives you, but also the flight to quality, because the sponsorship teams and the GP teams that I'm going to be investing with in my fund are going to be ones that have a track record, that are have gone full cycle on deals, right? That know what they're doing and have been doing this for a while. And so that's kind of a flight to quality, if you will, is kind of the other focus of the fund as well.
Mm-hmm. What I like about your fund, not as an investor, but as like a GP, is the fact that it's pretty passive for you, right? Like it's not passive, but you're investing in syndications that you're not the one on the ground making the decisions on the building. You're the one deciding which team is best for which project, and then getting a diversification over various projects. So it's basically, I'm really attracted to fund of funds, because even though I'm a trader at heart and I'm going to trade all my life, and I'm always going to have a hedge fund, I also want to have different funds, and a fund of funds is really attractive
Yeah.
because you have other teams of very, very not interesting, intelligent people working for you. So that's kind of what you have, but on a lower level, because it's syndications.
Yeah, and so it does allow me to be hands off on the projects themselves, but what obviously the value that I'm bringing is having relationships with those sponsorship teams. So, for example, right, the first two deals that I have in the fund, the San Antonio deal that'll be closing soon, and then the one in Dallas, I have personally passively invested with those groups. And I have seen a track record with my own money invested with them. They're still paying out their monthly distributions. They haven't done any capital calls or anything like that, right? So I'm kind of providing that, not kind of, I am providing that extra level of due diligence. And when there's a syndication done, right, you've got the GP team and the syndicators that are doing their own due diligence and underwriting. Then you've got the bank that is also lending money, that is doing another level of due diligence and underwriting. And I'm going to be providing a third level of that due diligence and underwriting, but not just at the deal level, but at these teams too, of their track records. So much of what's in this business, and you can appreciate this as well, is about know, like, and trust, right? It's amazing to me how people tend, not always, and I'm not saying 100%, but tend to care less about the deal itself and more about the person that they're investing with, right? And that is really what this is all about, is know, like, and trust, right? Knowing, liking, and trusting who you're investing with. And so people aren't going to invest with me if they don't know, like, and trust me. Well, I'm not going to invest in these syndication deals unless I know, like, and trust that team, right? So I've been able to build those relationships up over the last few years, invested with these groups, and that provides an extra level of protection for folks that are investing in my deal as well. And there's really no, I'm not aware of any funds that are structured like my fund. There's no equity split. There's no management fee. I've got a administration fee capped at 1%, which is really just to cover the costs of having the fund itself, right? Because there are costs with having this fund, but it's capped at 1%. If it goes over 1% of assets under management, I'm going to fund that out of my own pocket. If it ends up being 0.5% of assets under management is what it cost me, that's all I'm going to charge. It's not meant to be a profit center for me to make money. The only money I'm making on my fund is the money I am investing alongside my investors. So you're not going to find, I don't think you're going to find any other funds that are set up that way, with that kind of a fee structure, so favorably toward the investor, and that have the investor and the fund manager's interests aligned so perfectly, right? I'm only going to make money. I'm going to make the same money that my investors make, because that's the only way I'm making money on this deal. And so it's really a unique offering. My fund administrator that's running my fund, they've got hundreds of millions of dollars under management. They haven't seen anything like this, right? So it's really unique in the industry, and I've seen other funds out there that are just riddled with fees, and there's different types of funds and different types of investments within those funds and levels of effort and work that people do. So I don't mean to downplay, oh, well, nobody should be charging fees, and you're what you're doing is definitely labor intensive as well, and so I could definitely appreciate that. But from what I'm doing and what I've seen from what other people charge for what I'm doing, it's a little excessive. And so that's why I'm kind of coming in, and I'm just setting it up a different way, somewhat of a disruptor, if you will, in the way it's set up. And that's just the way I decided to do it. And I think it's a great investment. I think that obviously there's no guarantee on returns or anything like that, but we're targeting 16 to 20% annualized returns on the fund. And I feel confident that we'll be able to hit those, but there's obviously no guarantee. But yeah, that's sorry, I didn't mean to dovetail into the fund more, but just
No, of course.
conversation kind of went that way. So
Yeah, I think it's really interesting, and myself as well is the first time that I'm hearing of a fund manager who charge no fee at all, except the fee that is only meant to pay the expenses. And I have a friend as well who has a hedge fund, and he's kind of saying in the same mindset of not charging a lot of fees at all for his first fund. But
Mhm.
even then, he is still charging a little bit of fees.
Yeah.
But you're just, well, I mean, you're charging a management fee of 1%, but just to cover the expenses. So it's great that you're in a place in your life where you can allocate a lot of your time and effort into a fund and just be able to not make money in the first fund, to be able, but the goal is to help others, of course, and then to build relationship, to build trust. And then on the second fund, you'll be able to charge a fee and actually make money. Am I right?
Yeah, that's the plan. I mean, the plan is on the second fund, to probably add in a management fee or something like that, because, obviously, right, you have to make a living, right? So you can't just give everything away. But that's why, anybody that's interested in investing and is listening, like, get in this now while you can, while there's not the other fee, because,
Well,
that's
it's not
definitely, yeah, that's
maxed out
definitely,
yet.
what's that?
Before it's maxed out.
Yeah. The plan is to close it out at the end of 2023, and so once I get that closed out, and these syndication deals that I'm investing in, they last for 5 to 7 years, something like that. So once I close it out, it'll be, the funds will be invested, investors will be invested in the fund for that 5 to 7 years. But I am going to be closing it. It's not going to be an evergreen fund that people can just constantly invest in. It will be closed, hopefully by the end of the year is the current plan. Just depending on how everything goes, the interest I get, and the deals that I can find, and so forth.
Mhm.
So.
And so, what kind of waterfall are you getting from these syndications?
Yeah, so the syndications will vary depending on the syndication itself, right? And then the class of shares that I'm able to purchase depending on the amount that I'm investing in the deal. Sometimes there might be an opportunity based on me putting in a bigger amount that I can get a little bit better terms, but generally you're looking at 70 to 30 equity split at the syndication level. So 70% to the limited partners that invest in the deal, and then 30% to the general partner. So my fund investing in the deal would be part of that 70%. Sometimes you can negotiate a little bit better deal if you're putting more into the syndication, like an 80-20 type split. And then these syndications usually have what's called a preferred return, which basically and those are usually somewhere in the 6 to 8% range, which just basically means when you're invested in the deal, the passive investors of limited partners in the syndication, which of course then flows down into my fund because I will be a limited partner in the deal, get that first 6 to 8% of income and profits before the general partnership team gets anything, right? And so that'll all come down into the fund. And one of the things I haven't mentioned that is really good about real estate are the tax advantages, right? So the tax advantages, especially for people that have capital gains that they need to offset. Let me just preface this with, I'm not a tax advisor, but there are opportunities within real estate that you get from a tax advantage standpoint with some of the depreciation that we're able to take on the real estate that you don't get in some other asset classes. I've had investors that have sold stock at a capital gain, invested in a deal, and they were able to offset some of those capital gains that they would have paid on that stock that they sold because we were able to depreciate the asset and carry that over, and it offset some of that. Doesn't always work that way. Everybody's tax situation is different. So it really just depends on the situation. But that is another great advantage. And investing in the fund, all of those tax benefits of investing in real estate, whether it's a single family, a multifamily, it all passes down and flows down into the fund as well.
Yeah, that makes sense. Um, right. And so also, I'm not into real estate at all for the moment. I'm mainly my my portfolio is basically just trading options and stocks. So but I'm thinking about maybe going and buying an apartment, but renting it as an Airbnb.
Mm-hmm.
So have you ever done that? And what are your thoughts?
Yeah, so I actually have one Airbnb right now. It's on the coast of it's on the Gulf Coast, so one of the Texas coasts, and I'm actually in the process of selling it, primarily because it's pretty much doubled in value. So it's kind of a good time to look to sell. But I think Airbnbs are great investments. I think you have to be careful because I think there is some saturation taking place in the Airbnb industry. Some areas there's just too many now where there's too much competition, going back to the whole supply demand thing, right? So there's too much supply and not enough demand, and so that's not allowing the owners of the Airbnb to charge the right rates. And so I think there's some of that, but I think as long as you're careful and you're investing in a good market that's not saturated, I think Airbnbs are still a great investment.
Hmm.
Yeah.
Yeah, I mean, there. If I can get a better return than just renting it, and I'd be happy.
Yeah. I mean, and it all depends too. Airbnbs. The only thing about Airbnbs, especially, it depends on, with a single, like if you have a single family house and you're renting it, right, versus an Airbnb and you're Airbnbing it. If that's a word. The management fees, if you're going to have somebody manage it for you, the fees on having somebody manage an Airbnb is much higher than it is on a single family, long-term rental type thing, just because there is more work. I've always, all of my properties I've ever had, whether it's single family, small multifamily, or my Airbnb, I've managed it myself. And so I can tell you that, managing an Airbnb is definitely more work than a long-term rental, right? Because, I'm sitting there having to create the codes and everything for people to get into the lock and all that. And so, make sure, coordinate with the cleaners, make sure they get in there and clean and all that. And so it is definitely more labor intensive. But I think if you buy right and you get in the right area, you've got a greater potential for more cash flow with an Airbnb than you do a long-term rental.
And so, other than that, for someone who's starting who is starting his career in real estate, and who is not seasoned, so how would you recommend someone new starting to acquire real estate?
Yeah, I think that really depends on the person. I don't think there's one right answer for everybody. I think it depends on if the person wants to be active or if they want to be passive. That's a really big factor. I don't know how many times I've heard people say, "Well, I'm going to go buy a single family house to rent because that's a good pass. I heard it's a good passive investment." Well, that's not really a passive investment. Renting a single family house is not a passive investment. You could hire a management company, but even at that, that's not passive. They're still going to come to you for some stuff. You're still going to have to kind of manage the manager type thing, right? So it's not completely passive. The types of investments that people invest with me in, those are 100% passive. You're not doing anything, right? So I think it depends on if somebody's in a career, right? Like, doctors, lawyers, different types of professions, right? That they just want to focus on the career. They have no interest in managing a property. Then they're going to want to look at something that's passive, and just focus on that. But if you're wanting to learn to potentially be active and do it yourself someday, there's multiple ways to do it. And even with that, you could be passive. So when I started investing in the larger multifamily properties, these 100+ unit deals, the way I first learned about it was investing in other people's deals passively. And I invested in a deal in Phoenix, invested in a deal in Orlando, invested in a deal in San Antonio. I'd invested in 3 deals passively to kind of get a better idea of how the underwriting went, how the due diligence went, how those monthly updates work, the type of rehab that they're doing, things like that. So that was a really good education piece for me as well. I think that joining masterminds can also be helpful. That was a game changer for me. I joined a local mastermind here in San Antonio that yes, I got an education piece of that, but it was the bigger piece was being around people doing deals.
Mm-hmm.
And I know we've talked in the past a lot about networking and things like that. I think networking is a huge component, especially if you're going to be active in real estate, and whether you want to do it single family, you want to be a GP on a multifamily property or a self storage property, whatever it is you want to do in real estate. And even if it's not real estate, just investing in general, like networking is huge. You never know when in the future that relationship you made could pay off, right? And you don't build the relationships like, in your head, like asking questions like, what can you do for me, or how can this help me in the future? You just have to be genuine and build those relationships and have a genuine interest in the other person and network like that's how I network. And I think that's the most powerful and impactful way to do it and really build good long-term relationships. But the byproduct of being genuine and doing it that way is that you never know when that may pay off in the future. They may be bring a great deal to you. They may invest in a deal with you. So yeah, networking to me is one of the most important things you can do when you're starting out in any type of investing, really.
Yeah, I agree. And not only I agree, but networking is one of my priorities. I mean, there's trading, of course, and then the second is clearly networking and building relationships. And but one of the things that I've noticed, and like the hardest part about building relationships, is that I found that you lose relationships like if you don't make efforts to keep it, right? Like let's say I'll network with a lot of people, and let's say I'm getting your number and I'm getting your email, or I'm messaging you on LinkedIn and everything. Like I don't have time to keep the conversation and to keep like hitting you up every week. And if I did, like you would be like, who is this guy who's like texting me every week? So like I just forgot about all of these people, and like a year later, I'm like, who's this guy on my phone? Or like, who's this guy on LinkedIn?
Yeah.
So that's kind of one of the hurdles of the hassles of networking. I think it's like keeping the relationship once you've built like a connection, turning it into a relationship, and then actually keeping it.
That's I think that's a challenge that we all face. I face that same challenge. I mean, it is hard, and especially when you're busy with your day to day stuff and all that. It's hard to carve out time to do that. It's interesting. When I used to work in my W-2 in the corporate world, I had a boss one time that he used to have breakfast and lunch with, like, he had these little groups that he was constantly keeping a relationship with and networking with, just like every week getting with the different groups and staying connected and everything. And then he got fired and he had a job the next day because he kept these relationships and had that network, this massive network that he had built up and had these really good relationships with these people. He had no problem finding a job the next day.
Mm.
So, that's where it's not just, what can you do for me now or whatever. It is a long-term thing. And, for me, what I try to focus on is I try to make a concerted effort to really nurture those relationships with the ones that really click, right? With the ones that I just, it just really click and I really connect with on a deeper level. I'm not trying to say, don't keep good relationships with other folks, but there's also only so much time in the day, and you really have to kind of guard your time, and that's what I try to do is focus on that. I try not to delete too many of my text messages too, because every once in a while I'll go through my text messages and that'll kind of refresh my memory. Oh yeah, I haven't reached out or talked to so and so in a while, right? So if I try to keep those out there. I haven't gotten that notice yet that I need to delete anything. So I think I'm okay. But at some point I'll probably get that. But that's one way that I try to nurture those relationships. But I really try to focus on the folks that I'm really able to connect with.
Hmm. That makes sense because you cannot nurture a relationship with everybody, especially if you're going like us. Like where I think we're both kind of networking a lot. You
Yeah.
cannot keep a relationship with everybody, and so you
Right.
really have to pick and choose. Like like you said, the people you connect with on a deep level, and then also just the people who are in the same area, and that there's actually a win-win relationship that is probable.
Right. Yeah. I agree 100%.
Hmm. Yeah. All right. Well, I mean, thanks for coming in. It's been 60 minutes, and It was great to have you on the show.
Yeah, thanks.
And maybe once your fund is up and running, it's already up and running. Have you raised the capital yet or not?
Yeah, I've already closed on a deal. So we've closed on one deal. I have another deal I'm supposed to be closing on second week of May, I think.
Mm-hmm.
So it's up and running. Yeah. So if anybody is interested, feel free to reach out. I don't know if it's okay if I give my
Yeah.
So the best way to reach out to me is just you can send me an email if you want, brian@headstartequity.com. So my company is Head Start Equity. So that's my website, headstartequity.com. I am on LinkedIn. That's actually the only social media that I'm on right now. So if you want to hit me up on LinkedIn, you can do that as well. But yeah, it's up and running now. So yeah, for sure, reach out if you have any questions.
Yeah, and I'll put your email in the description.
Appreciate that. Yeah.
But is it like your fund is still accepting investment?
Yes. Mm-hmm. Yep.
But you're still beginning to invest.
Yes.
Okay.
Yep. Still active. Yep, for sure.
All right.
Actively taking in investors and still actively investing in deals. Yep.
Mm-hmm. Sounds good. So thanks for listening, everybody, and take care.